I'll first talk a little bit about the genesis and history of the JP Morgan DFI. We are the first, and as far as we know, the only private investment bank that has launched a DFI. So we are a bit of a unique construct. And so I'll give a little bit of information about why we exist. I'll then talk about how the JP Morgan DFI fits in the overall landscape of ESG and impact investing, terms I'm sure you've heard a lot about. And then I'll talk a little bit about our ultimate goal of creating sustainable development as a traded asset class to mobilize capital markets towards sustainable development. So the JP Morgan DFI was really born out of a realization that investment banks are already involved in development finance. They help raise capital for building schools and hospitals and infrastructure and renewable energy, often co-financing the same projects that development banks are also financing. But there's two fundamental differences. One is that development banks are what are known in the finance industry as buy-side institutions, meaning that they deploy their own capital as loans usually to projects and then hold those on their books until the maturity, versus investment banks, which are known as sell-side intermediaries, where on one hand, our clients are corporates and sovereigns that want to raise capital to finance their activities and projects. And we help them issue financial instruments and then distribute those financial instruments to institutional investors. Those are your asset managers, pensions, insurance companies, sovereign wealth funds, and the like. The second difference is that development banks have in their charter this core mandate of promoting international development. And as a result, they have advanced impact measurement and management systems to ensure that they're delivering on that mandate. So the thesis of the JP Morgan DFI was to use the same methodologies that the leading development banks use, but apply it to a sell-side business model and use it to evaluate the impact that the various securities and financial investment opportunities that we originate and structure, put an impact measurement management regime around that, and then distribute that to institutional investors that have some sort of appetite for impact investing. An analogy I always use is that if you think about JP Morgan's investment bank as the financial supermarket, where an asset manager would walk in with their cart and pick, an equity or, a bond or, execute a financial derivative, we are opening a development finance aisle in that supermarket, which is stacked with products that have that impact measurement and management regime baked into them. And so if an investor is interested in that type of product, they could come in that aisle, and hopefully with more traffic into that aisle, there'll be more investment flowing to this agenda. I think there's three main reasons. One is that the UN Sustainable Development Goals, which, as you all know, is a comprehensive, ambitious agenda to alleviate poverty and inequality and improve health and education and infrastructure, all while also preserving our natural ecosystems and combating climate change, requires a massive amount of investment. The latest estimates that I saw put it at about $5.7 trillion per year, and that's about a 1.7 trillion increase since the pandemic. So the pandemic really increased that number. And that's an investment required every year between now and 2030, which is the target date for achieving the SDGs. And currently there's only about 1.4 trillion going to this agenda. So there's a massive gap to financing this agenda. And the development banks recognize this. In fact, in 2015, they all got together in Addis Ababa and they issued a joint statement that development banks need to focus on how they can help mobilize more private sector capital towards the SDGs to help meet that big gap and scale up private sector investment from the billions to the trillions. This is often known in the development literature as the billions to trillions agenda. And so we went to the development banks, and most notably the IFC, they really supported us on establishing the JP Morgan DFI. And we said, instead of just using your physical capital to mobilize the private sector, you can also use your intellectual capital. Let's use your impact measurement and management systems and methodologies and apply it to the structures that we're originating and try to crowd in investment from the institutional investors who have trillions of dollars of assets under management into this agenda. I think the second reason is that we're seeing a real meaningful shift in investor appetite. I mean, going back to that supermarket analogy, the reason you have now in the supermarkets, all these products that are like, organic or fair trade or, have sustainability stickers or whatnot on them is because customers want them. People are caring, and there's, I'm sure, a lot of literature around why. It's, changes in demographics and social consciousness and the like. But we're seeing a similar shift in the investor community where investors care about the impact of their investments and increasingly want more data and metrics around it. You might have heard of the term ESG investing, and that's maybe the first incarnation of this movement, where it's more of a risk management approach, where investors try to minimize their exposure to investments that have negative, adverse environmental and social and governance risks with, various screens that they put and exclusions and so forth. The next incarnation of that is impact investing, and that's when investors try to get more proactive and intentional about the type of impact they actually want to drive. And they put some ex-ante metrics and targets against that. And there's a monitoring and evaluation regime that they put around it to track the progress against those targets. And impact investing maybe was very niche at its beginning, especially for emerging markets, and typically some private equity funds under $1 billion of asset under management. And they do, microfinance lending or finance a social enterprise in an emerging market and so forth. But now what we're seeing is that the big institutional investors that have the trillions of dollars of assets under management are also launching funds that have an impact strategy. And regulation is also helping with that as well. We're seeing, for instance, in the EU, the SFDR Article 9 requirements that are coming out is saying that investors that want to have funds that are Article 9 aligned need to be able to report more on the impacts of those funds. So that's a meaningful shift, and it's creating demand for us as an institution that caters to that demand. And then the third element, I think, is the whole Paris Climate Accords and the whole climate change agenda. Emerging markets today, they don't, outside of some notable exceptions like India and China, they don't really have a massive carbon footprint today. Most of the emissions are coming from the advanced industrial economies. However, if these countries do not develop sustainably, and if they don't measure and manage the impact of their development and ensure that it's being done environmentally responsibly, it's being done socially, inclusively, then we'll never meet the Paris climate agenda and we won't meet the prerogative of inclusive growth. So the SDGs and the Paris agenda are very interconnected and mutually reinforcing. And as the attention to climate is growing, so is some of that is spilling over to bringing attention to the SDGs. In November 2020, we were an underwriter for a bond issued by the government of Uzbekistan. And under normal circumstances, this would have been a general budgetary purposes bond, with the coupon, with the maturity. Investors would have bought it just because of, the risk of the issuer and, the return that would come in exchange. We were mandated as the development finance structuring agent for the government of Uzbekistan, and we worked with them very closely with their Ministry of Finance to understand the programs that the bond will help support and help them disclose a set of quantitative development impact metrics that will be associated with that bond and put ex-ante targets against those metrics. So, how many schools they're going to build, there were health institutions that they were going to build, there were kilometers of roads, kilometers of clean water pipeline, families to provide assistance for housing and for females for starting businesses. So all of those were outlined and put into a section in the bond prospectus, which we titled Development Impact. And that was really an innovation we brought to the market. There was never a bond with such a section that outlined all of that. And then we supplemented the syndication process. For those that might not be familiar with the process in financial markets, when the government is raising hundreds of millions or billions of dollars, we're not just matchmaking them with one investor. We are marketing that opportunity to hundreds of investors, and one investor might put in 10 million, another would put 20 million, until we build the book to finance that and price that paper. So we supplement the normal reach out, which there still might be investors that are coming in just for the risk and the reward, but we supplement that to additional pockets of investors that do care about the impact and want to know those impact metrics and targets. And the fact that it has that feature is an attractive feature for them. And so it brings in additional liquidity to that instrument that otherwise maybe would not have existed. We launched the JPMorgan DFI in January of 2020. And since we launched, there have been billions of dollars of transactions where we served as development finance structuring agent. But the reality is that if we're really serious about meeting the SDGs, it's really not enough, right? JPMorgan, even though we're the largest investment bank in the world, we're still, less than 10% of global capital markets. So that's why our last objective is really to try to scale what we're doing. And the way you scale is by standardizing and replicating. And so our philosophy from the beginning when we developed our methodology was to be open source. We put our methodology in the public domain. You can see it at jpmorgan.com/DFI. And we have been taking feedback from the investor community, from the development finance community, and we've been very open to share it with other capital markets participants. And we want to encourage more banks to help corporates and sovereigns issue instruments that have this development impact measurement and management feature. And we want, hopefully this to set off a virtuous cycle where there's then more asset managers launching funds that target this type of product, because now there's more supply of this type of product in the market. And so all of that could hopefully scale what we're doing from the billions to the trillions and help us all move closer to closing that very large SDG gap.